Let's start with bootstrapping very briefly. You know, a lot of entrepreneurs, especially first-time entrepreneurs, start off bootstrapping because they have to, but there are also some good advantages of bootstrapping. Companies are cash conscious. Scrap here. I'd like to start with Awele. Did you bootstrap ImproveNet, or how did you guys get up and running?
I'd like to relate some experiences from ImproveNet as well as from MShift, which is my current company. Perhaps more so from MShift. We started out in 1999, and we visited a lot of the venture capital firms on Sand Hill Road. However, none of our funding came from Sand Hill Road. At the same time, we didn't wait for venture funding to get started. Essentially, we started the business in my bedroom on my computer using existing software, existing hardware, existing resources that we had. In fact, the time when we made when we got our first major investment of about 10 million, the venture capitalist came over to do due diligence. He wanted to find out about this company. And they flew in from Europe, through New York, down to San Jose. And the problem was, where are we going to show them? We didn't have an office. And fortunately, we had a place where we were hosting the computer. But at the end of the day, they came over to my bedroom, to my office, to do due diligence on the software. But we had a product that was working. The point I'm trying to underlie here is that you cannot wait until you get money to get started, because that may be outside of your control. It's critical and it's important to get started and keep going as far as possible as you can. Create the product, pull together the things that you have, and just move. During the due diligence process, which lasted a long time, up until about 3 a.m. in the morning, the VC was investigating all the product to find out if it was working. Yeah, they were sitting in my bedroom, they were checking everything out, but it was working, it was functional. They did tests, international tests. He called back his office back in Japan and so forth. But the fact of the matter was, with zero cash, we had essentially gotten a product that could do the basics. Of course, we hadn't rolled it out big scale. So it's critical to move as fast as you can with what you have and not wait for resources before moving.
Continuing bootstrapping just a little bit more, Yemi, do you, as a VC, look more favorably on a company that has been able to bootstrap its way, to a certain point? I mean, is that, how do you view that?
Yeah, I think that's critically important on a couple of different levels. First of all, it shows that this is a group of people who have a passion and who are able to go out and create something out of nothing, right? Because you're coming in trying to raise money. Maybe you have a track record, maybe you don't. But the fact that you've been able to go out there and get something up and running is one proof point that maybe you have what it takes. The other piece of it is that, frankly, at the end of the day, it's not about whether you get venture capital or not. As an entrepreneur, what you're trying to do is make your idea come to life and build a company. Right? So looking at it from what Awele said, the important thing is that you just move forward with your idea. Now, he's a software guy, so certainly it's a lot easier in software to do that than in some other industries where you actually have to raise money and buy equipment to do things. So there's clearly an advantage there. But really what people are looking for is the passion. And the other piece of it is, contrary to popular belief, VCs are not risk takers, we're risk managers is the best way to think about it. I wouldn't say VCs are risk averse, because you're not, but you really want to manage your risk. And one way to manage the risk is to invest in a situation where somebody already has something up and running, something you can take a look at, because that takes some layer of risk away from your potential investment.
Good. Stephen is with Omidyar Network, which is kind of an unusual investment group. You're a mission-based investment group. So maybe give us a little plug on how you fit into the financing role.
Sure. So I'm Steve DeBerry. I'm investment director at Omidyar Network, and we're a mission-driven investment firm. And for us, our mission is about facilitating individual self-empowerment socially, politically, and economically. and we take a market-based approach to pursuing that mission. We're a $400 million fund started by the founder of eBay, Pierre Omidyar. And we invest in both for-profit businesses of venture investing, also quite a bit of microfinance, and we also invest in philanthropy. So for us, in pursuit of the mission, our primary concern is not whether an organization, which sector, for-profit or nonprofit, an organization is, but really how they help us pursue that mission. So like I said, we've been involved quite a bit in microfinance investing, but also been very active on the venture side here in the Valley. The last couple deals we sat across from, we co-invested with Benchmark, Fidelity, Excel, these kinds of players. If you'll indulge me, just really quickly, separately, I just wanted to share an observation, which is that I've been here in the Valley for about a decade, and I don't know about you, but I haven't seen a room like this, full of us. So I just wanted to acknowledge that and acknowledge the momentum that is evidenced by that and just celebrate that fact. I live here in East Palo Alto, and so just want to put that on the map. East. Yeah. Thank you.
All right, that's good. All right, kind of evolving beyond bootstrapping, a lot of startups will turn to the angel world. Maybe Aweli, did you approach angels while you're in your bedroom with your computer code?
Yes, in some ways we did. At that point, we took whatever funding that we could come across. It was important for us to start. We started with an intense sense of urgency. I can't overemphasize that. We had an intense sense of urgency. We had a sense of timing, a sense that this was a very big idea and it was very appropriate. But at the same time, we did not believe that we should be limited by whether we got funds or we didn't get funds. So we did get a little bit of angel funding coming in, but we also started out real big in terms of getting the motion going without spending as much. The first 5 set of hires that I did, I hired 5 people on the very first day. Their job was to clean out my garage and essentially lay the carpet, and the computers all came in the very same day. So we started in my garage essentially, and real estate was expensive, and we didn't really have the funds for that. And that was with angel financing essentially to get us going. So yes, it's a critical component. We took what we could get, but the sense of timing was paramount.
How did you find the angels? How did you?
Actually, the angel we found was through a conference. There was a VC investment type conference where entrepreneurs would come up and present some ideas, and there were people in the room hanging around who were listening to the ideas, and it was a real quick investment in the first round.
Yemi, what is your perspective on an angel round? Do you ever see deals that are kind of screwed up by the angels because of the way the financing has been structured? Or do you look pretty favorably on that? Do you get deals from angel groups, angel investment?
Yeah, we certainly do. And whether the deals get screwed up from a structural standpoint or not is really a function of the type of people you're working with. The advantage we have in Silicon Valley is that you have pretty well-developed angel groups, right? So these are people that are pretty savvy, they do a lot of deals. So the structuring tends to be pretty standard, frankly. But if it's a deal in, not to offend anybody who might be from the state, but from Mississippi, and there's some random guys who funded the deal, maybe it's not structured the way we're used to. It doesn't necessarily mean it's messed up in any way, but it's not in the way that we're used to. I think most of the angels here know what the VCs are looking for from a structuring perspective, so they're working with the lawyers, frankly, the same lawyers we work with. So the deals tend to come in pretty well structured. But the important function that they perform is they're willing to invest in companies that are much smaller than VCs are able to invest in. Right, so I think they're a critical part of the ecosystem, And it's one of the differences between Silicon Valley and many of the countries in Africa. For example, I was in West Africa, Nigeria, and Ghana last week, just talking to entrepreneurs about the challenges of starting businesses and so forth. And that's one thing you don't have. So you have people who do the quote-unquote VCs, but frankly, you would call them private equity firms in the US context. They want bigger deals where they can put more money to work, and they don't want to take any risk, right? Perfectly profitable companies. So you have this huge gap between the guy who wants to raise $100,000, $500,000 and the private equity firms that want to put $10 million to work minimum at any point in time. And that's one of the big advantages we have here in Silicon Valley, is that we have this nice angel network. We have people who not only have connections, but have been very successful at running businesses. So they can give you some money, give you a $50K or $100K to start, but they can also give you a lot of advice on how you run the company. So very important.
Do you guys think an angel network within the African network will emerge? I mean, we've seen that with the Thai and the Indian group, and there's a lot of Indian angel investors out there that are funding the next generation. Do you see a parallel?
Yeah, I see a parallel. So Peter's company is going to go public for $1 billion and is going to become an angel. So that's our plan. It takes time, obviously. So it's one step at a time. I think the more important focus right now is to get the entrepreneurial environment started, get people out there starting companies. As they do well and have successful exits, I think many of them will be happy to help out the next generation.
Yeah, I do want to add that it may not be obvious, especially in this community, but there is already a grassroots angel movement that's forming right back on the continent itself. I'm very much aware of some colleagues of mine who've left the U.S., successful careers in the U.S., to start up in Nigeria in particular, and who have tapped into funding from the wealthy individuals in Nigeria. So there is the angel network in Nigeria, although it's not as well-defined as it is out here.
Do you have any email addresses or websites?
Yes, I can very much give you that. My brother, actually, my brother was very successful in the U.S., and he's gone back and started a very big outfit. And his website is www.lionstonecompany.com. And he does a lot of stuff now, including investing. And he's tied to a lot of the angels as well. So
his Alexa rank is just going to skyrocket here. His page rank.
That's right. He'll be in the U.S. in a week or two, so if anybody wants to meet him, he'll be here.
Good. Stephen, is Omidyar more analogous to an angel? I mean, what size rounds do you guys usually put in, or are you a more traditional VC?
No, we usually come in Series A, Series B. We have relationships with folks like O'Reilly Alpha Tech Ventures and a few other angels that look at earlier stage deals.
All right, so let's get in a little deeper into the venture world, and maybe start with Yemi again. What is the minimum you expect? You guys are a little bit later stage than many VCs, but either speaking for your firm or for sort of a typical Series A type of fund, what is a minimum you expect in terms of customer traction or revenue? Do you expect profitability? What do you want to see when a startup approaches you?
Yeah, so it varies quite a bit depending on the strategy of the individual firm. As Nathan mentioned, we do later stage deals. Not later stage, expansion stage deals is the way we define it. But what that means as a generalization is that most of the product development risk is off the table. If it's a semiconductor deal, it's possible they just taped out. So no revenue, none of that. They have some design wins. So we don't have strict revenue targets per se. On the software side, a little bit later, just because the nature of software is, the joke we like to use is, anybody with some experience can get $5 million of revenue in software because you call all your buddies, friends and family, you get $5 million. It doesn't mean it's going to scale to 20 or 50 million beyond that. So we like to see more proof points. But for the early stage guys, the people who are very comfortable investing in two guys and a working prototype. So it really depends on what the strategy of the firm is. But from the point of view of the entrepreneur, the important thing this suggests, though, is that you do your homework and make sure you're talking to the right people. So if it's a later stage firm, it's a waste of your time and theirs to go pitch an idea where, you just have this nice idea, the prototype isn't really even working yet, and these are guys that like $10 million of revenue, right? So that's the important thing. Not all VCs are the same. People have the kind of different flavors of venture capital. People have different things that they care about, they're interested in. So make sure you do your homework so you don't waste your time and the time of the people you're talking to.
I think that's a really good point that applies across the stages, whether you're bootstrapping and just looking for folks that are friends, family, or advisors to help you, or whether they're angel investors or early, mid, late stage investors. All of these folks will have their own characteristics, strengths, and weaknesses, and I think it's a really good point of feedback to think about how these partners can help you achieve your objectives, and how the personality of the firm or group or individual fits with your personality, your work style, your staff, your team, and the networks that they can help you reach out to, whether it's customer relationships or strategic partnerships, these kinds of things. So I think fit is an important point to think about.
Good. All right. I'm sure there'll be some follow-up questions on that during the Q&A. Let's talk about the actual process of raising capital. Maybe, Aweli, this is one for you. How did you get the intro to the VC? How did you get the meeting? How did you, walk us through it? Walk us through that first pitch meeting and what happened.
The saying is always that you go through connections, and to a large extent that is true. A lot of the meetings that we had with VCs were lined up in terms of connections that we had, people that we knew. That got us into the door to present and have further follow-on meetings with the VCs. But I also want to debunk the notion that you can't get anywhere without connections. I think that is absolutely wrong, because we had so many meetings with all the VCs on Sand Hill Road and some in Palo Alto and other places, but the people who actually invested in us were not people that we knew. These were people who could see the technology, could see the value of the technology, and could understand the urgency of the process. But that said, I think it's important to put yourself in the right place at the right time, be part of the interaction between the VC. There's forums open where you can interact between VCs and entrepreneurs, and expand your network of connections as well. That doesn't hurt. But ultimately, it comes down to, do you have a product that works? Can you demonstrate the value of what you have to offer?
Maybe connect a few of the dots between that first intro and then, as you were describing, the due diligence in your bedroom.
Yeah, okay.
What happened in between this?
Well, I'll tell you actually, because I made a statement, put yourself in the right place at the right time. I would say one of the big breakthroughs that we had was that we decided to attend a conference that's called, it's one of the biggest wireless conference in the US. We had just formed, we've had very little manpower, and we registered, signed up, flew out to New Orleans and set up a booth and, presented. We're an entity, we're a player, and we put a description in there. That was very important. That was a breakthrough, because there were a lot of investors at that particular conference looking for companies that did different things. And it so happened that there was the particular investor that did invest in us saw the description of what our company did and came straight to us to talk to us. Now, to answer your question about what happened between then and when we actually got the funding, there was a lot of dialogue. We did talk in New Orleans. I think a few days later, we were in New York to meet the CEO. We flew out and did a live demonstration, which was running off of the server that was in my bedroom. But you can't tell where these things are running from in the wireless space. But yes, it was a live demonstration, and it was a very serious one, because he was, connecting back with his back office to actually test the product and exercise it. And 2 days later, we had another follow-on meeting here in the Bay Area, and that's where, the third part of the due diligence, coming to check out the system, the software. And at that stage, the foundation had been laid. There was confidence in the product that overshadowed the fact that it was running in a bedroom and that we didn't have an office. So I think that having the product running, having a solid product that you can show, may be even more important than necessarily just depending on networks of people. But again, putting yourself in the right place at the right time, it's critical. If we hadn't gone out to the show, if we hadn't stood up and said, hey, we're a wireless player, this is what we do, then the chances of meeting with investors would have been dramatically reduced.
So make some noise.
Yes, make a lot of noise, as much noise as you can make. Yeah.
Stephen and Yemi, anything to add on the process, maybe from the perspective of the investor?
Sure. I think I agree with Yemi's approach in terms of thinking about risk management. And if I were raising money, I'd try to think about it from the investor's point of view. And regardless of the way the process unfolds, because I've been involved both as an entrepreneur and as an investor in a range of different diligence processes. But I think in each case, it's really about telling the story about how you're controlling your risk. You want to eliminate market risk, and every dialogue that you're having should be about, or at least to the point that you prove it, proving that the market is there, eliminating the product risk, that your product actually works when they come to test it, eliminating the management team risk, that you've got a seasoned team, you know what you're doing, you've had success in this category before. Eliminating the competitive risk, that you know who the other folks are who are either out there in the market or could come after you. And I mean, you know them intimately. You know who they're talking to, you know what the last gossip has been, you know what their next move is likely to be and what your response to that would be. All of these kinds of things, so that, if you demonstrate that degree of understanding of your business and its facility, I think you're far more likely to influence investors to back you.
Yeah, the one thing I would add is, as an entrepreneur, you always fight in this battle, which is the battle between putting forward a story that shows you as a billion-dollar company in X number of years and being believable at some level. And I think most entrepreneurs are not even trying to mislead. They actually believe they're going to be billion-dollar companies, of which 1% actually succeed.
How many people here think their company will be a billion-dollar company?
Of course, that's right. Everybody, both hands. So that's the balance, right? So, but you also need to be realistic. You should realize that people you're talking to look at a lot of companies, and therefore have heard these stories before, and know that most of the time it doesn't happen. So I can't even tell you the number of times people come to me and you ask about competition, and like, well, in this narrowly defined space that we're in, there's no competition, right? Because it's so narrowly defined. It's like, yeah, so it's like this product going after this vertical, and we have 5 guys, and we're in Menlo Park, and all of this. And if you define it narrowly enough, there's no competition. But, well, if it's that narrow, it's probably not an interesting business anyway. All right, so nobody's going to believe there's no competition. There's always competition. There are always alternatives. Maybe competition is the wrong word, because maybe there are not 200 companies doing exactly the same thing. But from the customers, again, you look at competition from the point of view of the customer. So it's not from your point of view thinking, who are the people that are competing against me? It's from the point of view of the customer. How else can the customer solve this problem, right? That's your competition. So it might be an internal build, it might be something that's completely different from what you're doing, but from the point of view of the customer solving the same problem, therefore it's a competitor, right? So don't come up and say there's no competition, and you don't need to have all the answers. The team doesn't have to be complete, but you should be able to say, we need a VP of marketing, as opposed to, we have these 3 guys and they can do everything, right? You know where the holes are. We need a VP of marketing, would love your help to fill that hole. You don't need to have because nobody has all the answers anyway. Nobody knows how the market is going to evolve. But at least you need to have thought through all the issues before you present it. I think someone mentioned in the earlier panel that it's important to also, to talk to a lot of people, which is true, But also, you need to sequence that. So the first person you talk to shouldn't be the VC, right? So you talk to your buddies, you talk to other people, you kind of run things by them so that by the time, you never have a second chance to make a first impression. So by the time you get in front of somebody you want to get money from, you've made all the mistakes and you've gone through this, 201 times. So you have a nice pitch that is exciting but also believable.
Good.
Can I add a little something to that really quickly? Just this notion that I think there's no shame in going out and intentionally building a business that you know is not going to be $1 billion business, especially if you're thinking about bootstrapping, especially if you're averse to taking venture investing, because you need very large business to generate an exit that would be attractive to a venture investor, and also especially if you're maybe earlier in your career and you're not able to yet meet that requirement where you're able to demonstrate, I've had success in this category or with this kind of process. And I've bootstrapped a business, in the past that was not going after a venture exit. I was trying to build a cash cow so that I'd have the autonomy and independence to go back with a little change in my pocket and build something that, where I could swing out of the fence. I think it's like Isaac said, you hit a...
At some point, you're going to present to the entire partnership. That's pretty standard at most venture firms. At our firms, I like to do an operations review, which could be 1 or 2 days, where I go through and meet with all the executives. You do group meetings, you do one-on-one with all the executives, you talk about their business plans, and try to understand them, because you're not investing in just the CEO. The supporting cast is critically important as well. And then if it's a semiconductor deal, IP is very important. There's a lot of litigation in the area, so you might hire somebody to do some consulting work on that. So it really depends. It really depends on the specifics of the opportunity. It's difficult to really generalize, but I would say typically in this environment, 3 to 6 months. If it's very quote unquote hot, which typically means some sort of internet type, YouTube type deal, maybe you can get it done in a month.
Okay. And then what should the entrepreneur be doing to flesh you out? And maybe this is for both you and Stephen, and really, tell me what you did on the investor that put money into you. Did you check references? Did you ask, their portfolio companies?
So that was the second question that you asked. So it's also very, very important to interview the VCs. So don't go in there. I mean, it's difficult because you're asking for money, so you feel like you're in a subservient type position in the relationship, frankly. But you should also understand that if you have a good idea, there's going to be competition to put money into your company, right? So you should go in with a sense of confidence. It says, look, this is a great idea. I'd love to work with you, but I think I might have some options. So explain to me why, all things being equal, I should go with you versus somebody else, right? Because the VCs respect that, for one, because that level of due diligence shows that as you build your company, you're going to have some level of rigor as you do that. So you want to make sure you have somebody who has the expertise, obviously, in the area in which you play. Somebody who has the time, and this is critically important, because it's one thing to go get some big name VC at some firm, but if he has 25 portfolio companies, and some of them are much bigger companies than yours, how much time is he really going to spend thinking about you? There are only 24 hours in the day. So at some level, and this is not a pitch for myself, but you might want to go with a younger VC who actually has the time to spend on your company and is thinking about it, has maybe 5 board seats, not 25, all right? Because there's a
How many are you on? How many?
Approximately 5. So I mean, there's a fine balance. Obviously, you want the experience as well, but also understand that it's not enough to have. There's some benefits to having a big name. Right? There's some people, if you can get them on your board, it opens doors with customers. The IPO evaluation is a little bit higher. If you actually get to that point, no doubt about that. But understand that you want somebody who's there. When you place a call, you get a response to your voicemail that day, not 2 weeks later when they get back from some trip they're taking.
I think it's very important to do due diligence on the VC firm before you go. You want to know what their specialty is. Doesn't make sense going to a company that focuses on like biosciences if your product is IT or internet based. because you won't really get much traction with them. In addition, you want to look at what companies they've invested in. It's true that typically you don't get VCs to sign NDAs, although we did get some to sign NDAs. But you also need to be careful because the VCs are not bound even by the NDAs, so to speak. And if you present a very good idea to a VC who's invested in your competitor, you're sort of opening yourself up to early exploitation because that idea could eventually go out. Sorry to say that, but it's one of the cautions that an entrepreneur has to take. The VC themselves also don't feel too comfortable investing in anything that competes with their existing portfolios. So you need to do that due diligence and find out what they have. And as like Yemi said, you also tend to see what type of extra resources. There's this saying that it's not about the money. Sometimes it is about the money, but a VC can potentially bring a lot more value than just the money that they put into your company. And that's where you begin to look at what sort of load they have carrying.
Did you find that to be the case with your company? Did the VC truly add value beyond the money?
Well, yes and no. The first VC, probably not. The first VC was all about the money, which was fine by us. We wanted the money, we wanted to go. The second VC, very much so. In fact, the second VC has been very instrumental in multiple ways in linking us up with clients. They're a reseller, they're a customer, they're exclusive rights in Asia, they distribute a product, and they bring in a huge amount of money on a monthly basis just through the partnership that we have with them. So in that case, I wouldn't even call it purely a VC type relationship. It's more like a strategic partnership relationship. And that's one of the things to look at. I think there's a big emphasis here on VC funding and not as much on strategic investment. Strategic investment is where you team up with a company, kind of like the eBay PayPal relationship, assuming that PayPal as a fledgling company went to eBay and said, give us some money. That's a kind of strategic relationship. Unfortunately for eBay, they didn't have that opportunity and they ended up spending multiple billions, a few months later to buy the same thing. But if you can identify strategic type partnerships where there's a win-win situation, chances are that you'll get not just the money, but you get a lot more value on an ongoing basis. And that was the case for us with the second VC.
Stephen, anything to add there?
I was just going to add, how many folks out there are PhDs? I'm just curious. It's like one. In terms of the investor-investee relationship, I tend to think of it as like a PhD where the candidate gets to a point where he or she actually knows more about the specific subject than the advisor. And I think that's the kind of relationship that you want to find yourself in with an investor. I know with my companies, the CEOs that I'm working with know a whole lot about their specific product, market, et cetera, than I do. And I'm really there as a support. I don't see entrepreneurs being subservient to the investor. So, if the pitch and the due diligence process is about managing risk and identifying, what things you can kind of get off the table as risks, I think the working relationship after you consummate a deal is about collaborating to generate value. And the entrepreneur has a specific role to play and the investor has a specific role to play. And I think to your strategic point, it's about aligning your interests very closely, and working together successfully.
Good. Maybe one more quick question and let's open it up to the floor. One of the things I think is always on the mind of entrepreneurs when they're raising money is when they're going to get booted out, or if they're going to get booted out from the VC. Let's say you have a relatively hot deal. Can you negotiate on the possible change of management, or is it pretty much, if you're not executing, you're going to be out? In other words, how can you as an entrepreneur maintain some control yet still do the deal with the devil here? I'm just kidding.
I won't quite call him a devil, but
VCs are often, it's often likened to selling your soul, right? You're selling part of your company and you've made the deal. Yeah, going over the dark side.
I think it's very important for an entrepreneur at the very beginning to have the big picture in mind. I think a lot of entrepreneurs run into trouble when they try to hold on to power unnecessarily. The whole idea, the whole goal is that you want this idea to succeed and to succeed in a very big way, whether or not you're part of it. If your pride is tied too closely to the product or to the success of the company, you might find that you become an obstacle to the growth of the company. So the idea I like to think of is a situation where you create a process or a product, and the product goes on to succeed with or without you, whether or not you quit the company and put it in the hands of others. Fortunately for an entrepreneur, even when you're out of the company, you still own substantial equity. If you've done the deal right at the beginning, you still own a substantial equity. And in some ways, that's the best of all worlds because you have other people working to boost the value of your holdings. That said, at the very beginning stages, you set the platform in place in such a way that if the investors feel that it's in the best interest of the company, and sometimes they are wrong, but if that's the feeling that you are not the obstacle to the progress of the company, you should be willing to take a less visible role. You should be willing to do what is necessary. You could be the voice in the background. Whatever it is, you have to be willing to do it to see your vision succeed.
Stephen Yemi, do you have any comments on replacing the management and what it is?
I would generally agree with that comment. Like I said, I think the post-deal relationship is about creating value, and I think it's absolutely right. You're an equity owner in the business, and I think you got to be honest with yourself. If you are really a person who needs to be in the front of the pack at all costs, then it's probably appropriate to evaluate whether venture investing is the way to go. You can always, try to raise debt or, do it yourself, just bootstrap it, grow organically. There are other options, but if you choose the venture path, then I think the appropriate thing for both parties to do is enter and be committed to doing whatever's right to generate the growth of the company, increase the value of the company. That said, I think it's not uncommon for there to be shifts in the nature of the business and the roles that the entrepreneurs are playing. But there are I think easy ways to deal with that sometimes. I mean, I think one thing of many that often happens is a founder will migrate from an early stage CEO role into a chairman role, for example, where they still have a position on the board. They're still very much customer facing and evangelizing the product idea in the marketplace. But as the company grows and the operational demands change, you get maybe more seasoned operators in. So I don't think it's necessarily that it has to be a crisis situation if there's a need for a shift in management. I think if you're working with good investors, there are ways to get to win-win outcomes.
Yeah. I mean, the management team is just so critically important to the success of any venture that no VC is going to risk the success of the investment because somebody is upset. At the end of the day, I mean, it's just so, everybody talks about it, it's all about the people, but it's just so true, and you see it time and time and time again. Every now and then you can be rescued by a very good market, even if you're an awful CEO. But you can't really count on that. So it's so important that you have people in there, and when we make investments, we want to make sure, I mean, there's several questions we're asking ourselves. First of all, is this person a good CEO today? If the answer is no, we don't invest. Except if they're coming in up front saying, we need a new CEO, so that's fine. The other question is this CEO good enough for the next couple of years, and would we need to do an upgrade later on? In that case, then you have the conversation with the person up front. to understand where their mind is on it. So it's what I was talking about. Now, some people get so emotional, and I understand why it's so. I mean, it's such a difficult thing. It's your baby. You came up with the idea. You had the computer in your bedroom and the pizza boxes and all of that stuff, right? And these guys are going to come in and tell you you can't run it anymore. And emotional is just a very, very difficult thing. But at the end of the day, you need to be the sort of person that says, well, would I rather be one of the guys that own 5% of Google or try to run this thing and end up running it into the ground, right? And I would take the 5% of the Google myself. But it's all about the people. But some people can't deal with it, which is okay. But just don't come to a VC for money, right? So that's an important thing. There's nothing wrong with it. It doesn't mean you're a bad person. It doesn't mean you lack character. It doesn't mean any of those things. It just means that there's certain types of people you should go to for investment, typically not venture capitalists, but the banks, depending on the nature of your business, maybe you can get an SBA loan. I mean, there are plenty of other options for financing that one could pursue, but you should be really honest with yourself, because it's very easy to say, well, of course, I'll take 5% of Google after the fact. Everybody knows that's a lot of money. But when it really comes right down to it, are you going to be able to do it and step aside and maybe take on a part-time role, still helping the company, because you're the guy who hired many of the early employees, so having you there is typically valuable at some level if you're not being disruptive to the business. So most VCs will try to find a role for you if you're adding value to the business, but you really need to be honest with yourself. And if the answer is, I really want to run something and that's very important to me, maybe you should do something else.
Good. Let's turn it over to the audience. Do we have a microphone, or should we just put people up? Gentleman in the back there.
Came up earlier about looking for funding in Africa. Okay. Sand Hill Road is the wrong place to go to look for money for ventures in Africa. It's completely ridiculous, right? So this is what I was talking about earlier. Understand your audience, understand what they're interested in, understand what they're looking for. So wasting your time walking up and down Sand Hill Road saying, I have some solar company in Nigeria I want you to invest in. I mean, that's time better spent, frankly, trying to get customers or something value added like that. Those are the people you talk to. If you want to do ventures in Africa, you get off your butt, you get on a plane. Get on the ground. Get on the ground, thank you, right? and go talk to the people there who understand the market and who care about companies in Africa and are going to put money into it. Right. So just sitting here in the comfort of your home in Silicon Valley saying, hey, I have this nice business plan. If I can get somebody to give me $5 million, therefore there's no risk to me, right? So I can go start a company. Nobody's going to do that because it doesn't show the passion. The passion is you quit your job and you got on a plane and you got an apartment in Lagos and you started hustling. That's the passion. That's what the VCs are looking for. So don't look for money in the wrong places if you want ventures in Africa funded.
He just doesn't want to get deluged with 400
No, I don't.
banging on the door.
I don't mind. I have a vested interest in the continent, so I'm happy to help, but don't waste your time.
I mentioned that it's important to understand the strengths of your management team, including yourself as a potential CEO. But isn't there an equal risk of getting the venture capitalist or any of the funding believing that you're perhaps not as confident about your abilities or your team's abilities by you saying it would be quite fine for you to have another team replace us?
Yeah, you want to take it? So I think your question was, does it reflect badly on you if you come in and say, I'm not the best person for the job, somebody else might be better? Is that essentially what you were asking? Something like that, right? Actually, it's not. It's not. It's at least at our firm, we look at that very, very positively because it means you're aware of your limitations, which we all have our limitations, and you understand what's best for the business, and you've made the decision that maybe the best way to get this business built, the best way to build a successful company is for somebody else to do it. So it's very, very positive. Obviously, from a personal perspective, you probably want to try to figure out some role for yourself where you're part of it. But I mean, I don't think it's negative at all.
I think there are two issues there. One is clarity, and the other is accountability. If you are entering an investment relationship, I think it's important to be crystal clear with your investors what your objectives are and what you're going to deliver for a certain round of funding. And if you're clear about that, you can point to it, and you either will or will not have done those things. And that moves to point number 2, which is accountability. And if you have met those objectives, you'll be rewarded. If you haven't met those objectives, you won't be rewarded. So you want to reduce that to as clear a scenario as possible. I think it's a sign of maturity if an entrepreneur or an operator, a manager says, this is what I can do, and this is what I can't do. Because not everyone is expected to do everything. And just because you can't accomplish one certain task doesn't mean you're not a CEO either. Because good folks find, good leaders and companies surround themselves with folks that are a lot smarter than them about specific tasks that they're not good at. So, I think it's about being clear with your investors on what you can deliver and then delivering on it, and expecting the accountability based on that. And it's 2 ways. So if an investor, if you meet your obligations and an investor is trying to tell you that you're not, the leader that you are, again, fall back on the clarity. You have a clear agreement on what you said you would do if you've done it. It works both ways.
I want to add that as an entrepreneur, especially if you don't have a business background, don't sell yourself short. Don't think that you can't do it because you don't have, quote unquote, the letters MBA behind your back. Oftentimes, the preconceived notion is that someone with a technical background cannot really run a business, but that's not true. We all see the example with Sun and Scott, who's still running the business successfully. In fact, there have been several businesses I'm aware of that colleagues of mine started, turned over to quote-unquote professional CEOs who nearly ran it into the ground, and they took it back and kicked the CEOs out and are running it successfully today. Sometimes you have to do something to actually learn how to do it. And the fact that you don't have the credentials shouldn't make you go up in front of a VC and say that I can't run the business or I'm not qualified to do that. It's a two-edged sword. You can bring in a professional, but if he's not doing the job the right way and he's running your business into the ground, you still should retain your veto right to say, look, this is not the right person, and if I have to do it, I will.
Do we have the microphone? We have a question up here in the front.
Go ahead.
I have a question actually going back to angel investing. What are some of the considerations for an entrepreneur dealing with less experienced angels? And is there money you'd counsel people not to take because of implications it might have later on?
Take it.
I think there are a range of mistakes that an inexperienced angel investor could make. I mean, I think, again, there are many, but one classic example is an inexperienced angel investor coming into a very early round and investing at a valuation that's not digestible for venture investors coming later, and it would prevent you from raising venture money later. The solution to that is to raise convertible debt early so that you don't have a fixed price on the company. But, without knowing the full minefield, if I were in the situation, I'd call Isaac.
Now, I want to say that as you raise money, you should have a long-term vision. You don't want to go out and just pull out as much money as you want at the very beginning. If you raise all the money you need at the beginning, you end up having zero valuation or zero equity left in the company. Typically, if all things being equal, you like to raise as little as you can to move the company to the next round where the valuation will grow. So at the beginning, sometimes you have to do a sort of a balance, a trade-off. If I can get this angel funding right now and it would let me propel the company to this valuation tomorrow, it may be wiser to take that and run with it as fast as you can and build up your company rather than sit around for the next month or two waiting for, quote unquote, the right type of capital to come in. Ultimately, if you can quadruple the value of your company in as short as possible a time, it makes it much easier to pull in the next round of funding.
And maybe I'll just add one little comment. A lot of my clients have raised money. I think, find angels that can open doors. and keep the deal really simple, like Stephen was saying, using just a simple convertible debt arrangement so there's not crazy terms in there or evaluation. And I don't know, I think, you guys might disagree, but keep it so there aren't too many angels involved. I mean, if you have a dozen investors, you're going to be fielding calls all day long from these guys saying, how's the business doing? And you won't be able to do business. So, just one little observation. Who else has a question? How many people in the audience have pitched to a VC? Gone in and pitched? Okay, good. Good. And how many have raised some money from a VC? 3 out of 3. That's impressive. All right.
My name is Ted Okendo. Looking at credibility and image making, how can this forum change the perception that Africans are not educated, they cannot manage business very well like others, they can't take high-risk business, and do not have the credibility? I believe we have a lot of credibility, and I believe too, given the right environment, we can strive even better.
Who wants to field that?
I can take a shot at it. I'm not, well, I guess I don't agree that this perception are out there. Certainly, the education piece, I would disagree with. I don't think there's a perception that Africans are not educated. I think your question is more, I assume your question is more along the lines of you trying to raise capital from people here. I mean, maybe it's not, if that's what it is. So the credibility thing is certainly an issue, and credibility gets built based on data points that people have, right? So if you're talking to somebody who's never funded a venture that is run by an African or somebody of African descent, they don't know that, for example, just to give you a specific example, I think people are very surprised when I tell them that the average revenue per user for the cellular phone companies in Nigeria is $30. Right? Like, what? Isn't the average income like $10 a year? How can people spend this? But that's just a fact, right? So the numbers, Pitch had some numbers earlier showing GDP numbers. The GDP numbers for most African countries that are reported are maybe 20% of the real numbers, because you have the quote-unquote informal sector of the economy. All those people who don't pay taxes and so forth will have plenty of money to spend. So a lot of it, I think, is just education. But at the end of the day, if you have an idea that people think is going to make them a lot of money, and you can give a compelling reason as to why they should put money into it, I think you can get things funded, right? Obviously, if you're from a group, let's say you're an Indian starting a software company, there's already a positive bias that potentially you know something about software, right? As soon as you walk into the room. Whether that's true or not, it's a different story. But there's a positive bias that maybe you know something about software. That's not necessarily true if you were to walk in and say you were starting a software company. So there's certainly a bigger hill to climb. But I think at the end of the day, it's part of your job as an entrepreneur to really go after it and show people that you can make it happen.
Yeah, I want to quickly add a brief to that from a different perspective. How can you as an individual prove or add credibility to your story when you're trying to raise funds? I think that everyone in this room has a tremendous asset in the fact that you're operating in a society that is the same society as perhaps the VC you're approaching. The fact that you execute in this society and you execute successfully in this society gives you an edge if you now decide, I want to go back and invest. And the story is repeated. There's tremendous amount of success stories of people who've operated in the US and done very well in the US and decided to move back to Africa to start something. Those people have the experience, they have the credibility, and they have the connections as well in this community that they may fall back on to pull up to raise funds later on.
I'll back clean up on that really quickly. I had a chance to talk at lunch, so I know that that question isn't coming from an immediate fundraising point of view. So, you know, my take on that is, and it goes back to the thing that I said at the beginning, I haven't seen a room like this in Silicon Valley, ever. I haven't. I don't know if others have. I'd be surprised if there weren't the resources in here right now to support just about any robust early stage business idea. So, you know, my perspective is it's not about trying to proselytize and convince the folks that aren't in here now. It's about working with the folks who are already drinking the Kool-Aid, you know what I mean? Because we have the resources, right? And when we you know, generate the value that we all know is out there, there's plenty of potential. When we start executing on that, it's going to become a lot more clear to the rest of the world, to the rest of the community, the rest of Silicon Valley. Sand Hill Road will then be very interested in raising the Africa Fund, you know. But that just means more competition at the end of the day, right? So my recommendation would be look around at home. And when I say home, I mean, you know, kind of our community here.
I think one more question.
What is microfinance? Is $500,000 microfinance?
Much smaller.
Divide by,
So I think most of us, really, to start with, need maybe $1 million. We don't need $10 million, right? Depending on the project, again. Most of us just want to start something. And so the question is, how big of finance should we be looking at? $10 million is not what I'm looking for instance, right? And then the other piece is, there are so many opportunities in Africa, but most of it may not be technology-driven. The conversation in the room has been centered around technology, but there are some services, businesses, other sectors. How applicable is the VC process to these other businesses? Even though I know you're interested in that area, but can we talk about these other opportunities as well? Because
Sure.
a lot of us have ideas as far as directions we want to go, and they're not technology, because the need in Africa may not be technology now.
Right. So the one way to look at it, I think, is what I said earlier. So think of what you have to offer as a product, right? In some ways, I look at this as the first test for the entrepreneur. So the product you have is the opportunity for me to invest in your company, so not me personally, but generically an investor, to invest in your company and make a lot of money, right? So there's an ROI on the investment I'm making, right? It's the same thing when you go to talk to your customers, right? You're selling them something, but they should get benefit that exceeds the amount of money they're going to pay you for it, right? Exactly the same thing. So if you have a product that you're selling, which is the investment in your company, then you need to figure out who the customers should be. So if you want to raise $1 million, then you don't go to somebody whose minimum investment size is $10 million, right? So $1 million, that's classic kind of early stage venture capital level, right? So it's not something that's out of whack either way. So make sure you're talking to the right people. The other thing you mentioned is non-technology. Well, there are plenty of people out there. In fact, most of the private equity, broadly speaking, in investments in Africa today are in non-technology. Recently, there's been a lot of telecom, so maybe that skews it a little bit. But historically, if you look back over the past 5-10 years, it's been non-technology. So from the African context, it's actually a lot more difficult for you to raise money for a software company than for some investment into an oil field, for example, or some investment into diamonds or gold or something like that, right? So it's actually the reverse of what you have in Silicon Valley. There's a lot more money chasing infrastructure deals, minerals and things like that in Africa than technology. But people specialize at some level, so there are people who are comfortable with that, and those are the sort of people you should talk to. Again, it's matching the product to the customer.
I'd like to add real briefly. This is sort of a guideline I've developed over the last several years, especially as the bubble came up and burst. While you like to get as much money as you can at the beginning, you also don't want to get too much to dilute you too much. Typically, I like to use a concept I call the critical path concept. You chart a critical path, you're honest with yourself, you chart a critical path to how soon you can get to be cash flow positive. I know this may not go down too well with some entrepreneurs, but you really want to know how much money do you really need to get to the point where you're self-sustaining, and then you multiply that by about 3 to 5, so to speak, at the beginning. And this may not be, taking on the whole market, the whole US or the whole world. This is something, how much do you need to get to the point where if you're not able to raise the next round of funding, you're not going to go under. 6 months later, hopefully, if you have a real rapid rollout, you're able to get to that point, and if you raise the next round, great, you can expand. If you fail to raise the next round, at least you're coasting along and you're gradually expanding based on your own revenue. So that's sort of a rough guideline as to how much you should be looking to raise.
All right, I think we have, Stephen, did you have something to?
Yeah, just really quickly, it seems like the question was about the appropriate fit for the amount of capital that you're trying to access. So I just wanted to address a few of those, and then your specific question about what is microfinance. And I think that the term microfinance really got started by Muhammad Yunus, who won the Nobel Prize yesterday, and his first loan was at, I think $26. So it's really the concept of, based on trust and local community focus, investing very small amounts to help grow businesses. So you've got everything from microfinance, which really is micro, right, like on the sub $100 level, let's say, to individuals investing, and that might be at, a range anywhere above that, depending on the community. Other resources to think about, I think, are local banks, NGOs that have small business, punctuation programs, or government programs. I think there's also, venture philanthropy organizations. I think of Acumen Fund in particular, which is doing a lot of work focusing on Africa. They started out investing in a company that produces malaria bed nets, for example. And I'm going in sequence here to kind of the larger organizations. And then, towards the higher end, but not as large as, say, our NASDAQ market. I remember, I'm not an expert on all African markets, but I spent some time in Johannesburg last summer and talked with some folks at the Johannesburg Stock Exchange. And one of the issues there was that, Southern Africa is basically a resource-based economy, and so is the JSE. And so one of the things that they've started to develop there is what they call the Altex, JSE Altex, which is the alternative exchange. And the alternative exchange is trying to make a shift to accommodate companies that don't have to be, $20, $30 million company or the equivalent in Rand, so that they can accommodate smaller companies going to the public market. So, we can talk more afterwards, but that was just a really quick rundown from, sub $100 to public market, and at least one African example.
Let's wrap it here. I think we have to stay on track. One comment from Yemi, and you have one too? A couple quick comments. And then, yeah. How are we doing on time?
We're behind, but it's okay.
Okay. One last question.
What's that question?
The gentleman, this is how do you overcome the fact that Africans don't have any credibility because they don't have any education and so forth. And I'm not quite sure that that's the issue. I think the 800-pound gorilla with Africa is that there's political instability and there's corruption. You turn the news on, it's CNN, Chad, Darfur, Congo.
DC.
On and on, that's just hovering over Africa. It's one thing to establish a small business that's doing well in Africa, and to quit your job, go over there and get in front of African VCs and get somebody to fund the company. But if you want to go big time, if you want to be on the map, if you want to be on NASDAQ, if you want to draw international investors, how do you get around this issue with Africa? Because they're scared. There's this big issue hovering over Africa that I don't think we can ignore.
I think the question's not about, trying to make the case that there's not going to be political risk in Africa. I think the issue, back to the discussion we were having earlier, it's not about eliminating all risks. It's about managing the risk. And so, if you can help your investor see that that you've checked off the management risk, that you've got a team that knows what they're doing, they're experienced, they can rely on that you've got a product that's unquestioned, you know your market, you know your customers, all these other risks. If you can eliminate those and reduce it down to a question of, well, everything seems to check out, the market's there, the product's there, the team's there, but if we make this investment, we will be exposed to a systematic risk in that market, which is political. That's okay, because that's going to be factored into the price of the investment. So I don't think you should worry about, unless you have government relationships I don't know about, right? But you probably don't want to get tangled up in worrying about trying to eliminate all the political risk, but just focus on the things that you can address and be honest with your investors about the things that you can't.
A real quick comment. There's a Nigerian saying that the forest is a terrible place, but the lion lives in it. They are investors who are focused on those markets. If you go to the wrong type of investor, you're going to spend a lot of effort and energy getting nowhere. But they are investors who are focused on the African markets, who already are conversant with all the corruption and so forth, but still know that the highest rate of return anywhere in the world is coming from those developing markets. And from those investors, you'll get a quick answer.
Telling the right story to the right people. Let's give our panel a big hand here.